Well, good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. We also want to say good morning to those of you who are joining us in the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. And of course, we also want to say good evening if any of you are joining us from across the pond in parts of UK or Europe, or good early morning if you're joining us from parts of Asia or Australia. Well, welcome to today's Power Options presentation, focusing on your one-stop shop for options investing. Today, we're going to discuss how the patented Power Options tools are going to help you find new positions, research and analyze the security, the underlying security or the option criteria, evaluate what-if scenarios before entering a position, how our tools will help you track and manage your options positions with ease, and also evaluate rollout opportunities, adjustments, or management techniques as well. A basic quick introduction: the Power Options service was created by Ernie Zerenner back in 1997. He created these tools after he retired from Hewlett-Packard, where he'd worked for several years, and he was a self-directed options investor who had been trading since the early 80s, since maybe before then as well, in options. But of course, at the time, he had to do multiple services, read newspapers, go to the library, evaluate the security, then look to see if the securities he found offered options, what the return would be and what the premiums would be. And the reason why he created the Power Options tools initially is because he wanted an easier way to be able to identify positions in multiple strategies, analyze those positions, and have everything in front of him in one place rather than going to multiple services. We've, of course, expanded the tools over the last 17 years based on customer feedback, different analysis approaches, different management techniques, and different search capabilities for the various strategies that we support in Power Options. And, of course, for those of you who don't know me, my name is Mike Chupka. I am the Director of Education here at Power Options. I've had the great pleasure of working with Ernie Zerenner and the Power Options staff for the past 12 years. I have co-authored 2 books on options investing. I've presented many different seminars and, of course, a variety of webinars, and done many blog articles and education for various option strategies, option management techniques, and more. So that's just a quick introduction. Now, as options investors, many of you may have multiple services that you're using for your stock analysis, your options analysis, and management techniques. Well, as options investors, we are considered the most savvy investors across the markets. We have a lot of different things that we need to analyze, research, and plan for before entering a position, more than simple stock ownership, just as much as any futures or binary options or anything along those lines. When we're looking to open a new position, the more important than the actual option position is the underlying security. If the underlying security is not match our sentiment for the trade that we're looking to enter, we're probably not going to have a good probability of profit. The second most important is meeting our trading goals and sticking to our trading plan. Meaning that if you're a covered call investor, you want to have a plan in mind where you're looking for a reasonable return. Sure, we'd all like to make 10% or 15% per week or month, but we know that's not likely. And part of a trading plan for a covered call portfolio might be that we're looking to generate 2 to 3% per month, or maybe 0.5 to 1.5% per week on our positions if we're using the weekly options. But we have to meet our trading goals, and we have to select the option strike prices and the option position on our underlying security that makes the most sense and matches our trading goals and risk tolerance. And the third most important is the management techniques as well. This is what we need to have at our fingertips, and this is what we need to use when entering positions and managing our options trading portfolio. Now, for the underlying security, as investors, we know that we can find bearish positions if we're in a bullish market. And we can also find bullish positions if we're in a bearish market. There will be some positions out there if the market's falling that some stocks, ETFs, or securities will be going up. If you feel the market is turned, of course, and you're looking to do bullish strategies on a general basis, a good plan might be to go forward and look into investing in the inverse ETFs, sort of the short ETFs that will rise in price with the market as it declines. But in addition to finding the security that matches our sentiment for the strategy, we have to make sure we select the right strikes for your needs, and the sentiment of the security has to match that. For example, I could do a deep in-the-money covered call that offers a lot of downside protection and a small return of maybe 1% or so, If looking at a $50 stock, I sell maybe the 42.5 strike or the 40 strike where I'm collecting a lot of intrinsic value. And I could enter that covered call, and if my expectation was because the stock was going to fall down to $43 or $44 per share, I wanted to have some protection in place. Well, unless covered calls are the only things that you're qualified to do, there are other strategies that are better to take if you think the stock's going to fall from $50 to $43 in that time frame. You can get a much better profit doing different strategies rather than just trying to stay with a one-trick pony. But the point here is that we have to find the sentiment of the security that matches the strategy as well. Now, the strike price selection. There are do's and don'ts in every strategy. We talked about covered calls already. Selling a too deep out of the money covered call. So if I buy a stock at 50, I'm expecting it to move up to maybe $58 or $59 within the next 30 to 60 days. So I sell the out of the money 57.5 call for 20 or 30 cents. Well, that's probably not going to match my trading goals. Even if the stock matches my expectation, we have such a low probability of that occurring that it doesn't make sense to do that. Of course, we talked about going too deep in the money. Yes, we might be doing that for protection on a stock that we've been holding long term, a core stock in our account. But at the same time, if we think there's going to be a decline in a 30 to 40 to 60 day period on the stock, maybe 8 to 10%, there are better strategies that we could use to maximize profits and, of course, even hedge the long stock position. Speculative call buying. Buying calls or buying puts that are deep out of the money. We've got a stock trading at $50 and we say, hey, you know what, I think this stock's really primed to take off. I'm going to buy a 3-month or 4-month out 60 strike call, a deep out of the money call for 40 cents or 50 cents or maybe even 80 cents to pay lower premium. Well, this is not going to match your tolerance over time. And what I mean by that, there are gurus out there who sort of advocate buying deep out of the money calls and deep out of the money puts depending on your market sentiment to maximize returns if the stock really takes off. But as a regular investor, as a retail investor, most of us won't be able to stomach opening 10 or 12 or 15 long call positions that are 10 to 20% out of the money that we paid a small premium for just to watch 80 or 90% of those calls expire worthless and hoping that the 1 or 2 calls that do make a return because the stocks took off balance out what we lost on the other 8 positions. There are better ways to approach it in the market, and that's what we're talking about, selecting the right strike price. Many of you might be trading credit spreads or debit spreads. And when we look at a credit spread, say a stock trading at 50, and I want to do a bull put credit spread thinking the stock's going to stay up, well, I'm likely selling a 47.5 put and buying a 45, slightly out of the money to give me a better probability of success. Does it make a lot of sense to sell the 52.5 put and buy the 50 when the stock's trading at 50 and I'm speculating that the stock needs to move up to 52.5 where I could realize the full profit? Well, that doesn't make a lot of sense long term because every position you open might only have a 40 or 50% probability of full success. Your return might be closer to 100% of what you invested for the margin requirement, but you're only going to be right 40 to 50% of the time, and that's probably not going to lead to a profitable portfolio. And of course, debit spreads the reverse. We typically want to be slightly in the money when we open a debit spread. A lot of people, investors, may speculate with out of the money debit spreads, but then again, they have that low probability of success. So we need the sentiment to be moving in our right direction, and we need to make sure we're selecting the right strike price to match our trading goals. And finally, management techniques. As options investors, we know that even if I select a deep out-of-the-money credit spread that comes with a 90% probability of success, or maybe you're doing ratio spreads that have a high probability, or iron condors, for example, over time you are going to have to manage one of those positions. And when we look at credit spreads long term, if you are opening credit spreads that have a 90% probability, you're probably looking at a 4 or 5% return on the margin requirement, meaning that you're probably close to a 10 to 1 or 15 to 1 risk-reward ratio, that if one of those spreads goes against you and hits the full loss, it could wipe out 12 or 15 previous trades. So you can be right 90% of the time and still lose money. So without proper structure and proper position sizing and having an exit strategy in place, it is possible, even with covered calls, deep out of the money naked puts, credit spreads, debit spreads, even calendar spreads, it's possible to have a high percentage of portfolio winners in that given portfolio and still be losing value in your portfolio. And we'll talk about that a little bit more as well. But these are the important things that we need as options investors. We need to have the ability to select the options that match our goals and our tolerance. And what we mean by that are things that match the price that we want, or the premium that we're generating for selling, or what we're paying for buying calls or puts. Focus on the return that matches our goals for a monthly or weekly or maybe even far out in time. The probability is important. Some of you may use delta instead of probability. That's fine as well. Evaluation of some of the Greeks. And of course, we want to look for positions that have good liquidity. At the same time, we also need the ability to select the stocks or the underlying securities, whether ETFs or indexes, that match the sentiment for the strategy. I don't want to get into a bull put credit spread on a stock that's been declining and looks bearish just because it has a good return. That's not a winning scenario long term. Then we also, of course, need to look for the unknowns, the ability to research and analyze. Any information about the stock we just looked at that has the return that we want looks like it's in a bullish sentiment for a bullish strategy, but is there anything out there, rumors or discussion about a boardroom scandal, a pending patent lawsuit, an upcoming phase 2 or phase 3 FDA trial, anything that could cause the stock to move against us, which we can't find in looking at certain things such as the analysis, the stock volatility, the 52-week trading range. Those criteria don't tell us those stories, so we need the ability to do further due diligence and do it quickly as well so we don't miss opportunities. And last, we need the ability for ease of tracking, getting the sort of overall view, the bird's eye view of our positions, whether they're multi-leg or single-leg strategies, managing those positions, and ease of use to evaluate rollout opportunities or adjustments to turn potentially a loser into a winner, or potentially maximize profit on a position that is going in our direction as well. So now we're going to walk through how easy it is to open, research, analyze, and track positions using the PowerOptions suite of tools. But first, so we can focus our presentation to what your needs are, we're going to launch a poll here, and I want to know, what strategies are you currently trading right now? Are you mainly looking at covered calls and naked puts, sort of income generation? Are you looking at protective option strategies, married puts, standard collars, or dynamic collar positions? Are you looking at the vertical spreads, credit spreads, debit spreads, or even iron condors? Also, butterflies might fall into that. Are you looking at speculating on options, buying calls or buying puts, for example, to speculate on market movements? Or are you looking at what we might call the time spreads? And the time spreads would be diagonal positions, calendar spreads, or horizontal spreads, the vertical spreads there, or I'm sorry, the diagonal spreads there, the calendar spreads to maximize your portfolio. So we're going to leave this poll open for about a minute, and I encourage you to vote, of course. All right, so we're going to have about 10-15 seconds left in the poll. If you haven't voted yet, I encourage you to do so. All right, so let's go ahead now and close our poll. We've got a couple more votes coming in, but we're going to go ahead and close the poll now. I'm going to share the results with everyone. So what we have in today's audience, 82% of you are looking at covered calls and naked puts. Second place, actually, 64% of you are doing the protective option strategies, married puts and collars. 55% of you looking at vertical spreads, and 4 to tie, with 45% doing speculative long calls and the time spreads as well. Okay, so let's go ahead and hide that poll results there. And let's go ahead and navigate over to our PowerOptions suite of tools. And let's talk about opening new positions in the strategies that you selected. Now, I was 11, 12 years ago, I was starting out. Many of you may be new to options and just getting started. And there's a lot of information related to options trading. We've already reviewed that already. We need to know about the stock, we need to know about the option, we need to know about the strike price selection, liquidity, and other factors. And all of that can be overwhelming. And I'll admit, we've designed the PowerOptions tools to be this one-stop shop for any investor that comes in, whether they're advanced, whether they're just starting out, or whether, of course, they're trading advanced strategies, or they're just trading covered calls and long options. Many of you may say, well, I understand what you're saying, Mike, but I don't know what I would look for in a covered call position. The 82% of you that answered it, you may say, I'm not sure what stock I would want to look for a covered call position or a naked put position. Well, let's take a look here. I'm going to click on our main covered call tab, and as we see here over on the right hand side, of course, the basic profit and loss chart of a covered call position is fairly simple. We know that this is a neutral to bullish position. If we're not married to the stock, meaning we're not holding it long term, we want a stock that's going to be trading at or above the selected call strike price that we're selling. All right, that's where our maximum return lies. We know that we're exposed to the downside. This is where collars come into play to give us some protection here so we have a limited risk. Even using stop orders, many of you know that can be broken through with an unexpected event that happens in the pre or after market hours. So with a covered call position, we need to find quality stocks that are neutral to bullish, that are moving up in price, and at the same time, as we mentioned, we need to find the right strike price that matches our trading plan. Now, for those of you that are just getting started, we're going to help you out. In PowerOptions, in any strategy, we have tools and default searches that you can use as a stepping stone to create your own personal search. So in every strategy, if you're not sure what criteria you want to use, we can start off in the sample searches menu underneath every strategy. And the sample searches is going to give you basic reports where we've put together criteria for you of what we would look for in different strategies. And what I mean by that is that inside every strategy, there are different strategies inside of it. You can be aggressive as a covered call investor. You can be neutral. You can be protective, more conservative as a covered call investor. You can look for lower returns, but on dividend-paying stocks that you're looking for long-term growth, or you can just be doing shorter-term positions where you're looking for that 1, maybe 1.5% yield on a weekly option or every 7 to 14 days just to try to maximize your annualized returns. So there are different strategies inside every strategy. But depending on whether you're aggressive, conservative, or a little bit more moderate, the default searches that we have here, there's a 7-11 report here for covered calls. This is looking for higher return positions with decent downside protection. This would be considered more aggressive. Broker and advisor recommended, well, this would be more of a conservative covered call default search that you can use as a stepping stone to create your own personal search. If you want to look for covered calls on ETFs, dividend-paying stocks, stocks with a good 5-star rating, for example, or if you have a smaller account and you just want to look for covered calls in stocks that are under $10 or under $25, we have default reports that you can use to identify positions. Now let's start off with one of our sampled searches. Let's go ahead and click on the broker and advisor recommended. This is going to show us covered call opportunities on stocks with good recommendations. They have to be part of the S&P 5-star list, so 5-star rating by Standard & Poor's, and currently in an uptrend. And that's what we'd want to look for in a covered call and possibly a naked put, isn't it? We want a good, strong stock that's neutral to bullish, but again, it has to match our trading plan, and we have to put our management techniques, and we'll get into that later. So as I click on the broker and advisor recommended, we see here that there's a list of potentially about 12 positions that match our default criteria. Okay, and what we're going to do is just take a look at our first one. And I'm going to highlight some of this for you, and we're going to look at the basic chart. Well, we see that CBI, Chicago Bridge and Iron Company, I don't know this stock, I've never traded it, is currently trading at 53.86. We could sell the June 54 call, that's 23 days out, slightly out of the money, for $2.15. So this would lower our total net debit in the position to 51.71. We're essentially right at the money. This gives us a good protection of 4% and a potential max return of 4.4%, which is a good return for a 23-day trade. Over the years, I've learned that on average, a covered call portfolio should expect about a 2 to 2.5, maybe a 3% return per 30 days. Okay, somewhere in that range is what your goals want to look for. Can you find positions that are offering a 5% or 6% return if assigned 30 days out? Absolutely, and the PowerOptions tools will help you identify those. Should you expect to always get that higher return, that 5 or 6% return on a consistent basis with a covered call strategy? My experience is no, especially when volatility is at the lower end of the cycle as it is right now. However, that being said, what are we going to do with this position? Well, we know that we have maybe a downside protection that maybe matches what we're looking for. And at the same time, we're looking for a percent of assigned, which is a good return but our probability of getting assigned and earning that return is right about 50% because we're right at the money. All right, so what are the first thing I'm going to do? Whether I use one of the default searches in the PowerOptions tools or one of our sample searches, before I start researching and analyzing a position, I want to scroll down below the listed trades and see exactly the criteria that are set. In every strategy, you'll have 4 basic views to set your personal criteria. So we start off with the options criteria here. We can set our expiration time frame. Right now we're just looking at the standard June expiration. I'm going to walk through creating a screen from scratch in covered calls and naked puts in just a moment. We can screen for implied volatility, so the static implied volatility for the options. If we wanted to look at the implied volatility range as part of our analysis, where is the options implied volatility now compared to where it has been over the life of the option? Or using things such as the IV over HV, the implied volatility of the stock historical volatility, or IV over SIV, to analyze overvalued or undervalued options as well. The returns for a covered call, the things we want to focus on the most are perhaps the percent downside protection. How far can the stock drop before we're technically losing money on the position? The return if unchanged, or annualized return, and also, of course, most important is the percent if assigned. What is the max return we could expect on this position? In other strategies, such as the naked put and credit spreads, you'll see the same type of fields, but just a slightly different nomenclature. For example, instead of percent if assigned on a naked put, we'll see the percent naked yield. And for a credit spread, instead of percent if assigned and percent naked yield, we'll just see the percent return. But that's where we want to set what we want to see for our goals as well. If you have a specific requirement, we want it to be more conservative by doing in-the-money covered calls. Of course, with naked puts, we'd probably want to be out of the money as well. We can set the range in or out of the money based on strike price or based on percentage from the current stock price. What's also important, of course, is the price and strike price fields for our positions. And in the price and strike price, we know that we may see a small stock, let's say a $15 stock, and we could sell the 14 strike call, and to get a 1% return, we might only have a 15-cent net credit. Well, that matches our return goals, but if you're only trading 200 or 300 shares because you have a smaller account, is a 15-cent premium going to match your investing goals? Probably not. So in addition to setting the minimum return that we want in any strategy, we also want to make sure that the premium we're receiving makes sense for our portfolio and our trading size. In credit spreads, for example, many of you may be doing weekly options, and you know that when still looking for that 80% probability or above, with a credit spread that expires in 5 to 7 days, you may only see credits of 10 cents, 15 cents, or 5 cents. That might be too small long term for your investment goals. You may need to force the system to find you credits with at least 20 cents, 30 cents, or 50 cents. And if they exist, this tool will find them for you. Other things more advanced that you can do here, the bid-ask spread. You can limit your bid-ask spread or percent bid-ask spread. And of course, the probabilities. If my probability assigned on a covered call, probability of expiring worthless in a credit spread, iron condor, or naked put as well. So in addition to setting the range out of the money for those strategies, we can also set the probability. And then, of course, the liquidity for the option. My volume today, my open interest, and the percent current option volume. Those of you trading long calls might want to look for more active options that are showing interest. That's where that percent current option volume comes in. So you can see what is the option volume today compared to where it has been over the life of the option. So that seems complex, but once we identify our trading plan, we don't need to put everything into all of these fields. What we need to do is just have that setup of the 10 or 15 criteria we'd use that make sense for our positions. Now, before we start adjusting some criteria here, for example, we see here that on our basic view for this sample screen, the minimum percent if assigned we're looking for is 2% or greater. But if your minimum requirement for your personal trading plan, either if you're 20 days out or 30 days out, you're going to look for a minimum return of, let's say, 2.5% or more if you're assigned, then we simply want to make that change into the field. I'll change my percent if assigned to be greater than 2.5% or more. Why not? Let's change our downside protection to greater than 4% also. And we'll go ahead and submit the search. We've really narrowed it down to just that one trade. It's a slightly in-the-money covered call opportunity now on CBI Chicago Bridge Networks, which is at 53.86. This would give us a smaller return than we saw when we'd be out of the money, of course, at only 3.2% yield. But we have a 5.6 downside protection and close to a 60% probability that we'd be assigned and earn our 3.2% for 23 days. Okay, but what did I talk about at the beginning? I talked about that in addition to selecting the right strike price, probably the most important thing is the stock selection. I want to find a stock that has good liquidity, probably has positive earnings per share, has shown good management, and is likely trading in an uptrend. Now, our default search, we've set some of that up for you here. So if I'm going to go to the fundamentals now for our options criteria, for the stock criteria in our covered call strategy, we see that just some of the things that we have entered is we're just looking at stocks between $9 and $100. Well, I don't know your account size. I know mine. And if I'm doing a covered call, a married put, or a cash secured naked put, my account size dictates that I'm probably not doing stocks more than $75 or $80 per share. Now, I know we've already limited it down to one result, but if that's the case in my stock price range, I'm just going to change this to, let's say, between $5 and $85 per share. And we look at the technicals. We had mentioned, of course, that we were looking for stocks that had a good broker recommendation. That is part of the default screen we started with. And down here at the bottom, we're also looking for stocks that are currently trading in an uptrend. There are many other criteria we can use. If you want to use stocks that are in a certain percentage of their 52-week range, if you use beta for your analysis, average stock volume is one I'm going to talk about in just a little bit. Some other technical indicators, you have RSI. If you use the Bollinger Bands or Bollinger Band ranges, you can set those as well. And MACD is another one that I might use, or days that the stock has been above the 20-day, 50-day, or 100-day moving average. And of course, we just selected a base for the stock price to be above the SMA 50. However, if you wanted to look for stocks where, let's say, the 50-day is above the 100-day, you could select that as well. Or if the 100-day is above the 200, or if you want to look for stocks, for example, where the current price is above the 20-day or 50-day moving average, or if the stock in the current SMA 20 is above the 50, you can set that as well. I'm just going to go back to our default here for the time being. Okay, now you may ask, well, why didn't we have more technical indicators here for this default search, and why is there only one thing entered for the fundamentals? Mike, you had mentioned earlier that you may look for stocks that have a good earnings per share growth, or maybe mid to large cap stocks. Many of you may know that as you're doing covered calls, naked puts, or credit spreads, you're going to avoid stocks that have an earnings date between now and expiration. So why aren't these selected? Well, one of the reasons why they're not is because this particular default search we started with, another feature that you can use on PowerOptions, if I go into the lists field, we can choose to screen specifically against a certain sector or industry, depending on your risk tolerance and what you're looking to trade, or you can exclude a specific sector or industry. One of those popular selections I talk to investors about is they look to exclude on the PowerOptions tools maybe the healthcare sector, or specifically the biotech and biotechs and drugs, to avoid those high flyers that have a phase 2 or phase 3 drug trial coming up. That's not something maybe you'd want to trade a covered call against. The stock could gain maybe 50 to 60% of its value in a brief moment once that approval comes out. But if it fails the phase 2 or phase 3, you may see your $15 or $20 stock drop down to $1 per share in an instant, either overnight or during the trading hours. You're looking at a large substantial loss, and no stop loss order or trailing stop will help you from that 80% or 90% loss. But as I mentioned, what we're looking at here for the covered call technique, this particular default strategy, we'd said that we were looking at the 5-star rated stocks. So we have various stock lists that you can choose to use to narrow down your universe of options. Things such as the IBD 50, just the Dow 30 industrials. If you wanted to screen for credit spreads, for example, just against the indexes and ETFs to avoid the volatility of stock fluctuations and the unknown, that's there as well. NASDAQ 100, S&P 100 and 500, or the 5 stars. And of course, you can create your own personal list. If you have a list of stocks, 20 or 30 stocks that maybe you found, I have some subscribers that use VectorVest, for example, as part of their analysis for stock selection. They get a list of 20 or 30 stocks. Well, I can create my own personal stock list and choose just to screen against that. And we can also choose to exclude any of those lists. So if we want to exclude indexes and ETFs, or the inverse and leveraged ETFs, for example, the 2 times or 3 times ETFs, these are all things that we can choose to exclude from our search results to really help us save time with our options research and analysis. All right, so let's talk about one more time. And we've got our stock here. We're going to come back to CVI in a little bit. But let's talk one more time about our basic bullish strategies. Okay, so many of you said that you're doing credit spreads, long calls and long puts, and the calendar spreads, the time spreads as well. For neutral strategies such as our covered call, neutral to bullish strategies, naked puts using out-of-the-money naked puts, buying calls is more bullish, but that falls in the same category, bull put credit spreads, even the standard callers, married puts, and calendar spreads, I'm going to be looking for stocks that I feel are neutral to bullish. And what are my requirements? Well, my requirements may differ from yours, but let me show you how easy it is to generate your own personal search. So whether I clicked on the default search or I opened a sample search, I can come down into our covered call parameter field here where I set our different criteria, and I'm going to select clear filters over here on the right-hand side. That's going to empty out all of my options criteria, the stock technicals, the stock fundamentals, and our lists as well. Clean slate. And I'm going to go ahead and change this sort right now to just percent if assigned for our covered call positions instead of percent if unchanged. Now back to what we discussed at the beginning of the presentation. What I feel is the most important? Well, the underlying security. If I'm entering a neutral to bullish position and I'm not looking at neutral to bullish stocks, well, I highly doubt that I'm going to be profitable long term. What are some of the base criteria that I'd use for a stock that I'm expecting to show strength and to grow over the next 30 to 60 days? All right, well, I'm going to start off in the fundamentals. And this may not matter for credit spreads, okay, but for stock selections, again, standard callers, covered call where I'm buying the underlying, married put position, still neutral to bullish, and of course, cash secured naked puts where I'm not investing in the stock but I have the full margin. What do I know? I know that I have to have my stock requirements. Based on my portfolio size again and the number of positions I look to open, I know that I'm probably only looking at stocks between $5 and $85 per share. If you have a larger portfolio and you want to extend that up to $150 or further, that's perfectly fine. What else am I going to look for? Well, Ernie and I over the years have had a lot of conversations about this, and we feel honestly that one of the main things that forces growth in the stock, so whether it's the next 30 to 60 days, whether it's the next 90 days, if you're in a strategy that you're expecting a growth of 5 to 10% on your stock over a period of time, well, the one thing that drives that is going to be the earnings. So you're going to want to make sure that you're looking at stocks that have a positive earnings per share growth. So here in the fundamentals, we use the percent earnings per share growth, and I'm just going to start off with only those stocks and tell the system to narrow it down to only those stocks that have shown at least 5% growth in earnings over the last year. In addition to that, I know many of you may trade small cap stocks, and there's nothing wrong with that if you can be successful. But in general, for a more neutral to bullish strategy, I probably just want to focus on more liquid stocks that are mid to large cap. And here in our market cap field, when I hover over that particular filter, it gives me a description. The market cap field here on PowerOptions is measured in millions. So in general, small caps are considered 0 to 2 billion capitalization. Mids are going to be 2 to 15, and large are 15 or higher. But down here below, it shows me that if I want to use mid cap or higher, I want to look for a range of 2,000 or greater. So I'm just going to put that into the market cap. And what do we know about these other strategies we've talked about, these neutral to bullish positions? The one thing that can hurt us on the downside for naked puts, covered calls, standard callers were protected, but I don't want a stock that has the potential to have an unexpected event and fall quickly. Bull put credit spreads, bull call debit spreads, and so forth. I don't want to particularly be in a stock that has earnings coming up between now and the expiration. I don't want to get stuck with that stock that has the 20 to 25 to 30% decline overnight or in the pre-market hours. So in our earnings date field, we're going to check the box for not between now and expiration. All right, let's go over to the technicals field. And we talked about some of the things. We could use brokerage, but let's just avoid that for now. One of the things I'm going to look for is good liquidity. And what do I mean by that? Well, we know that we're looking at mid to large cap stocks, but I also want stocks that show a good average stock volume. And this field, of course, is measured in thousands. So I'm going to look for positions that have at least 750,000 shares traded per day over the last 90 days on average. So we'll put in a field of greater than 750. We're in a neutral to bullish position, so I know I'm going to want stocks that are trading in an uptrend, and I'm probably looking 25 to 30 days out. We're going to use a standard expiration first. So I'm going to keep that field we had before, stock above the SMA 50. But if your criteria dictates you want to look at the 20-day moving average or stocks where the 50 is above 100, that's what you'd want to set. I'm not going to look at RSI right now or MACD. We may come back to that later on. So let's just talk about what I just entered for the stock. Did I use any particular stock lists? Not right now, but we could easily do that if we want to just follow IBD stocks or the S&P 5 stars or create our own personal list. For a neutral to bullish strategy, again, covered calls, calendar call spreads, standard collars, married puts, naked put positions, bull put credits. This is the same criteria I'll use for each one of those strategies. I want stocks that have good liquidity, an average stock volume. I want a stock that's trading in an uptrend. That might hinder us right now based on the performance the other day. I know I have to be within my stock range. This might not apply for a bull put credit spread because we're going to use margin on that one. I want stocks that have shown good growth and good management. I want to look to mid to large cap stocks, and I'm going to avoid stocks that have an earnings date between now and expiration. I don't want any subtle surprises. Okay, so that's the same criteria that I'd use for any of those strategies. Now, what about our option criteria? Let's move over to our options field. And again, excuse me, let's just select the standard June expiration. That's 23 days out. We'll talk about weeklies and so forth in just a moment. Now, creating a basic search from scratch. I'm not going to worry about some of these advanced things such as the implied volatility and the IV range. I'm going to talk about why in just a moment. But what do I know about my covered call position? I know that I'm going to be 23 days out. So close to that 20 to 30 days out, I'm going to probably be looking for a minimum percent return if assigned, about 2.5%. And in general, I may want a downside protection. Again, how far can the stock fall before we start losing money on the position? It's just the option premium divided by the stock price. I'm probably going to want that to be around 4 or 5%. I'm going to start off with 4% right now with a minimum 2.5% if assigned. We are going to want a minimum option premium. It doesn't make any sense for me maybe to trade that $6 stock if I'm making 10 cents, and that might reflect 5 or 2% yield, for example, but I'm going to need more premium than that. So I'm going to set a minimum here in my option bid price for my covered call of at least 50 cents to start. I'm not going to worry about the range in or out of the money right now. I'm going to explain that in just a moment, but I am going to worry about my liquidity. I want to see active options. If you don't know what is a good requirement to use, our general rule of thumb here at PowerOptions is you probably know, in addition to knowing your account size and what kind of stocks you'd look for in this type of strategy where you're purchasing the stock, you also probably know how many shares on average or contracts that you're going to be trading. So if you have a medium-sized account, you might be opening a covered call with 300 or 400 shares and selling 3 or 4 calls against it. Well, a general rule of thumb is if you don't know what to use is for the current volume today, what we recommend is looking for a volume today that's at least 5 times the number of contracts you're planning on trading. So let's say that in general, I was going to be doing 500 shares on average in 5 calls. I'm going to look for a basic option volume of greater than 25. And now for my open interest, I want that to be close to 10 times the number of contracts on average I plan on trading. So we're going to look for an open interest of at least 50. Now, let's review very quickly. For our basic stock criteria, we just looked for stocks that had good liquidity, trading in an uptrend, in our price range, and we're avoiding earnings between now and expiration. We wanted to look for positive growth in earnings. Not very complex. At the same time, we're looking at the next standard June expiration for our option. We want our minimum return of 2.5%, decent downside protection of 4%, and we want a minimum premium of 50 cents and some good liquidity. That's not really advanced criteria, but let's go ahead and take a look at what we've got. Now, this is not bad at all. This is actually where I want to be. And what do I mean by that? Out of the entire universe of options, and the 4,400 or so optionable stocks, indexes, and ETFs, and roughly close to 400, or I think it's closer to 300,000 call options available. With just that basic criteria of looking for good stocks, good stock performance, good liquidity, and the options that match our criteria, we have narrowed down the entire universe of options to only 13 covered call opportunities for the next 23 days. This is the perfect example of how the Power Options tools will help us save time with our options research and analysis. We've quickly filtered out everything that we didn't want to see and have focused it on just those positions that we want. And this is the same thing that's available in any of those available searches. You'll see the same setup for the 4 criteria: options, technicals, fundamentals, and so forth, whether you're doing credit spreads, calendar spreads, diagonal or horizontal spreads, the protective options strategy, straddles and strangles, and more. Now, we have our results, and I chose to sort these results by the highest percent if assigned. We could change that and look for the highest downside protection if we're more conservative. But we see that our first result here is Altera, ALTR. I saw that in the news recently. Stock's currently trading at 46.87. Now, I'm looking at a 47.5 June call. It's slightly out of the money, but we will be able to collect almost $3 for this position. Now, what does that tell me? That tells me that this is a little bit out of the norm for an out-of-the-money call. It's got a high percent if assigned and a high downside protection, which is great where we want to be. This max return, of course, is based on if the stock's trading above 47.5. But this is outside of the norm. The basic rule of most things also applies to any options investing. If it looks too good to be true, it probably is. And one thing I'm looking at here is I see a high implied volatility. Now, I know right now that the average implied volatility of all optionable stocks is around 0.35 right now. This is almost double that. And what does that mean? It means that something's going on with the security. Something's been out in the news which is causing this to increase in price. And of course, we've got a probability of 47%. Now, if I wanted to be more conservative, we could go deeper in the money and look for better protection as well. But is this a good covered call opportunity? Well, let's take a look. First off, the first thing I always do with any position, I know the stock matches the criteria that I looked for. It has to be in an uptrend, has to have that good earnings, per share growth, has its mid to large cap, and the option criteria matches what I want. But the first thing I want to do on any position is in any search, we'll click the More Information button, and I'm going to go to Charts, and we can take a look at the 1-year snapshot, but I'm going to go to Big Charts. And you can customize Big Charts based on what you want to see. And for example, what I like to do, everyone's a little bit different, but I'll change the time frame right now to 6 months from a year. And what I'm going to look at the indicators here is I'm going to look at the SMA. I could use the 20 or the 50. And then for the upper indicators, you can use things such as the moving average envelopes, parabolic SAR, Bollinger Bands. I use the Bollinger Bands. Everyone has their own personal preference. But I'm also going to look at the MACD. I'm going to look at the RSI, and of course, it's good to look at volume. But Big Charts allows you to look at other things such as the fast or slow stochastic, the Williams %R, money flow, accumulation, and more PE ratios, so you can add that as well. I'm just going to keep this simple for my needs. Let's go ahead and redraw that chart. All right, so now we have our position. Real quick, I'm just going to go ahead and click Store the Chart Settings, so every new chart we look at is going to have that same criteria. All right, so just looking at the chart, what are some of the things here that we're concerned about with Altera? Well, on a good covered call strategy, naked put, I'm probably more looking for a stock that's more stable to neutral, that has shown some good growth, and maybe has a good pattern of lower left to upper right, and is a little bit more consistent. Altera is kind of all over the place, but it has been in a bullish all over the place, hasn't? We had a spike here, which might have been due to earnings, and there was a slight pullback, and then it popped up again, but then we had this nice decline. So if we got in at this point, when it was going above its 50-day moving average, we bought it at 44 and maybe sold the 45 call. Let's clear that up there. Well, as the stock then after that point from 44 dropped down to 41 or even $40 per share, we would have been at a loss and had to manage that position. Well, then it popped back up again, so if we managed and rolled down and then it popped back up, we could be in trouble. And then there's another pop again. So something's going on with this stock that I need to know about. So before I go any further, if for whatever reason you decided that this chart does not match what you'd want to see for a good covered call position, a good bull put credit, or a cash secured naked put, we would just close down the chart, back to our search, and from here on out, if I decide that this isn't matching, it's too volatile for what I want, I'm just going to avoid the Altera positions. I don't need to research those anymore. I'll just move on to the next one, JMEI, and we'll start the same process again. However, we're going to stay with Altera for a moment because my second process in any strategy, once I've run my search, I looked at the chart. If I decide I like the chart, I need to go to the company info, news, and recommendations. So I'm going to take a look at the news articles. And all I'm looking for here is anything that might cause me hesitation for entering this position. Well, I see Altera is trading above its moving averages. Yeah, we saw that on the stock chart. New strong sell stocks for May 22nd. Probably want to look at that article and see why Zacks maybe said Altera was a strong sell. Rumors of buyout. Intel should buy Altera. Might not be bad for a covered call, but then there's something there that's going on that we might have an issue with. So I'm just going through here. Potential merger with Intel. Okay, that's what's going on. So now I have to go into the details and see if Intel has made a tender offer. What is that tender offer? This might be a position I want to avoid because it's all over the place. What happens if Intel doesn't make the offer and our Altera stock drops down to that $42 or $40 range we saw it dip down to within the last month? That's not a good thing for a covered call position. So these are the things that I'd want to look at. In addition to the news, of course, you may want to just check a look at the earnings and events and so forth. Okay, what is the next step? Maybe we looked at the chart, we decided this was still okay. We looked at the news and information, we decided nothing there was going to hesitate us from entering this position. We've already decided that Altera is probably too much for us right now. There's too much going on, too much speculation. Might not be good for a covered call, might be good for a speculative long call or probably a long straddle or strangle where if the stock swings in either direction from these continued rumors, we might be able to profit. But not for a good covered call position. So we're going to skip that. And we're going to move to this next one, JEMI. Don't even know this stock, trading at $22.73, slightly in the money, 22.5 call for $1.75. Again, it looks a little bit more volatile, but let's take a look. What do we want? Stock chart. Take a look at that. That's why. Okay, this stock was doing what we wanted to in this range here back 2 or 3 months ago. It was moving strong above its averages, broke out of the MACD range, but then we had probably a poor earnings event or something here, and the stock collapsed from $28 down to $22 per share. Now that it's below its 20-day moving average, do we think it's going to recover? We might speculate on that, but I don't think this is a good position. So, real quick, let's just move to Wisdom Tree. The third one down. Let's take a look at the chart here. Okay, there we go. Oh, that just stopped for us a second. There we go. Sorry about that. All right, so this one is a little bit better. Why do I say that? Well, we've got some recent events here. And yes, it's pulled back and it dipped below its 20-day moving average, but then we came back above it. I like this here where it's crossed back over in the MACD and it's heading towards this range. The RSI is moving up again. Many of you might say, well, that's a negative. Of course, we wanted to get in here, and we could set up the search to do that, to look for stocks that have just crossed the MACD, or the MACD has crossed the signal line just one day ago, or where the stock RSI is below 50 and maybe looking to move up. Those are settings that we can use in PowerOptions as well. But this has now come back up above its 20-day moving average. It's showing strength in the last 15 days or so and getting close to the upper Bollinger Band. This is more, yes, there's been a pullback recently, but it's rebounded. So this is more something I'd want to see in this range for perhaps a covered call position. You may have a different security range and different chart that you want to look for, but that's okay. That's why you have the search criteria that you can adjust for that. All right, so next step now, we looked at the company information, we looked at the chart. Now I want to look at the recent news headlines for WTF. Okay, they're presenting there. Wisdom Tree ETFs declare distributions. Okay, Euro parity. Wisdom Tree stock gains 5.3% in session. We saw that on the chart. Okay, so these are just some of the things I'm looking for. I want to see if there's anything that might cause me hesitation. 3 years in growth stock investors will love Wisdom Tree. That's a positive. Upgraded by Keith Briette. That's positive as well. So far, this looks like a better opportunity. If you're more aggressive, again, that volatile Altera position might match your needs. JMEI, well, it looked like it pulled back too much. There's too much concern there. So it looks like now Wisdom Tree, even though it's a lower stock, but this is more along the lines of what I might look for a covered call position. Well, what's the rest of it? Well, we've got a stock trading at 2103, June 21 call. We could sell for 110, and this is going to give us a 5.2% downside protection, fantastic, and a 5.4% max return if assigned. We're right at the money, so we're going to be at about a 50% probability. All right, so what's my next step? Now, I just want to take a look at the analysis here. And what I mean by that is I'm going to run a comparison. I like the stock chart. I didn't see anything in the news that would hesitate me from entering this position. So what I'm going to do now is go ahead and look at the option chain. Now, for covered calls, I'll look at the option chain. For my other strategy, I'll look at what's called the search by symbol tool. And if I'm happy with the 20 strike or the 21 strike, I might be happy with the 20 strike or maybe the 22 strike. We'll take a look. So I'm going to go to the option chain for WETF. And the power options chain, for those of you doing covered calls or naked puts, we show you the important returns right on the chain. If you enter this as a covered call, from looking at the put chain, I'd see the naked put and the naked yield as well. So this section here is our percent if assigned if we enter it as a covered call, and our downside protection as well. Well, if we went out of the money with a 22 strike, if we were more speculative on WETF, we'd still collect about 70 to 80 cents. This only gives us a 3.3% downside protection. That's why we didn't see it in our results, but it does offer a 8.5% if assigned. Well, that's if it's assigned, if it's trading above the price. But we probably only have about a 36% chance or probability. It's actually 36.7% chance we'll get assigned and earn that 8.5%. The 20 strike is pretty interesting. Bid ask of $1.65 to $2. So we're getting the premium we want, the time value of about 70 cents, which is above the 50-cent requirement we put in for the option bid price minimum. This gives us almost an 8% downside protection and still a 3.5% if assigned. So why is it important? Even though the search result pulled up the 20 strike for us, or 21 strike, I'm sorry, with the 5.2% yield and the 5.6, why do I want to run this comparison? Because now that I know the chart, and I've seen that there's been a pullback recently, it's broken above that, I can still get my goals by being more conservative and selling the 20 call here instead of the right at the money 21. Okay, and of course, if we go back to the search, we'll also see that there as well. The wisdom tree one would also, the second one will also be in our return. Well, it's not right now because of the volume and open interest. I just saw that, but it does match our return for 2.5% and our minimum downside protection as well. So in this case, I might be more inclined to go with that 20 strike call at the midpoint with about a 7.9% yield and a 3.5% return, now that I know the chart a little bit more. But if I'm more aggressive, I'm absolutely staying with that 21 strike with that better 5% yield as well. Okay, so that comes down to your personal tolerance, but the tools have allowed us to quickly analyze that to view what we wanted to see. So now the last step. Let's say we're staying slightly aggressive here, moderate. We're taking the at the money call. Now that I've run my search based on my criteria, I've identified my positions. Now we're researching and analyzing. We're doing our due diligence. We like the chart. We didn't see anything in the news or information that would cause us hesitation to enter the position. We compared it to our other strikes, but we decided at this time we're sticking with the at the money 21 call for a little bit more speculation. So my last step now is the what if scenarios. So using that more information button from the search, we're going to link to the profit and loss chart for our position. And here we just see the basic view of if we bought 100 shares of stock, right now dropped a little bit, trading at 20.98, sold the June 21 call for 110. We could get a little bit higher with the midpoint. We still have our 5.6% yield if the stock remains or moves above 21 in the next 23 days. And of course, we've still are investing 1988 total. It's our cost basis. So what do I want to know? Well, we saw the chart before. We saw it pull back below its 20-day moving average. We saw it pull below 20 within the last month. So I can say, well, what's going to happen to my position if the stock, say, drops down to 1950 at the midway point, halfway between now and June 19th expiration, say around June 9th. Let's go ahead and hit calculate. Well, the stock was trading around $19.50 per share. At this point, we know that we'd be just a little bit below our break even, but that's at expiration. But here we see we'd have a loss of $148 on our stock. We'd gain 86 cents on the call, so we'd have a loss of only $62 per share. At that point, I'd probably buy to close my 21 strike call and maybe roll down to the 20 strike, maybe even the 19 strike if it's still profitable to get extra protection. But am I comfortable with this position of losing 62 cents if the stock drops down to $19.50, almost $2 in premium? Well, really almost $1.50 in premium from where it is right now. Well, I'd say, okay, 62 cents is not bad, and I'll still be in a good range to management. Am I happy if the stock moves up to, let's say, $23 per share at the midpoint? Well, of course. Now, I'm not going to be near the full return of 112, but I'll be close to it. So at that point, at the halfway, we'd have a gain of 202 in the stock, but it's going to cost us 108 more to liquidate the short call, but that's still a profit of $94, close to about 86% of our max expected profit of 112. So I'm happy with that scenario as well. Now on the profit and loss chart, here we're doing that at the money call, remember, now slightly out of the money, but it's really still at the money. But if this time I wanted to run other evaluations, well, this is a good return, 5.6%. But what if I'm concerned that it pulls back way below 19? Something happens in the market. I think this is bullish, but what happens if it doesn't do what I want? Rather than using a stop order, what we may consider doing is adjusting the position by making it a collar. So I'll go to June. Here's my available strikes. I'm going to go with a cheap put here. I'm going to go with the 18 put for 30 cents. I'm going to take 30 cents away from the $1.10 price. Well, we've got a bit of $1.10 to $1.35. So let's say we can actually get $1.20 for this, and we're going to pay 35 cents for that 18 put. So I'm going to go midpoint. I'm going to pay full ask price right now of 35 cents for the 18 put. This is still a neutral position, and this is still pretty good, a little bit higher than I'd want. Usually when I enter these standard collar positions, what I look for personally is a percent return if assigned of still around 3 to 3.5%, but a maximum risk of really no more than 5 or 6% if I can avoid it. In order to get that lower maximum risk in case I'm wrong, I'm probably going to have to go up to the 19 strike, which will reduce my max return more, but at the same time I'll probably be in a range of 5 or 6% risk, with still being in a return of maybe 3%. But that's just a way to cover ourselves. A stop order will cover you during normal trading hours, but if it's an overnight gap and the stock falls to $16 or $18 per share, I'm not expecting that to happen, but that's the black swan. This is where that proper position sizing and trading plan and exit strategy always come into place in these scenarios. Okay, so let's go ahead and take off our collar here. And let's just go back to our main, here's our main position here, but let's go back to the main search for the time being. And what are we looking at here? Well, we've got our wisdom tree. We like the stock. We like the chart. We like the price. Everything about this matches what I need. I would potentially enter this stock as a cash secured naked put, as a standard collar if I could work out the numbers using probably the 19 put instead of the 18 that we just showed. It would be a candidate for a covered call. I'm not giving a recommendation or suggestion, but this is what I would look for. Now that I've done my research and analysis, we've got our criteria set, we've looked at the chart, the company information, we compared it to our other strategies, and we run our what-if scenarios. My last step, of course, is we're going to go ahead and place our trade. Now, we do have a broker link with Options Express, but my last step, of course, after I enter my trade through the broker link, or I log onto my broker and place the trade, I'm going to come back to PowerOptions, and we're going to select Add to Portfolio. Now, if you've already created portfolios, you can go ahead and select those here. I have different ones for radioactive trading, straddles, other things we've done for the webinars. We're going to create a new portfolio today, and we're going to go ahead and call this the WETF one-stop portfolio. And what I'm going to do here is we're going to do, later on this week, we're going to do some other examples, and we're going to follow up with this. But for right now, we're just going to put this in the one-stop shop WETF, and I'm going to go ahead and click Insert. Now the system knows I'm doing a covered call position. It has everything filled out for me except for what we want to put in. So we're going to put in that we're just going to buy to open 100 shares of stock and keep it simple. It's a paper trade, so we're going to use 0 commissions. And at the same time, we're going to keep our stock price at $20.98, but we saw that midpoint was probably about $1.20 that we could get for it. So we're going to treat this as a paper trade. I'm going to go ahead and enter that. Let's go ahead and submit the position. Okay, so now we've got a covered call entered into our portfolio. Where we're at now, we've put on our search and analysis, we've put in our criteria that identified the strategy that we were looking in, neutral to bullish strategy. We talked about that criteria. At the same time, we did our due diligence and our quick links to further research and analyze the position. Now we're going to track the position and analyze it. Okay, so we've entered it into the PowerOptions portfolio tools. The first step I want to do when I enter a new position here is, of course, what do we know about this strategy? Then our position as a whole, I should say. Well, we knew that our total net cost going in, buying stock at $20.98, selling the call at $120, that put us at a debit of $19.78. That's our break even at expiration. And the stock's at $20.98. So what I might want to do is I'll have my trading plan in place for a covered call or other strategy. I may want to be notified if my stock drops to, let's say, $20 per share, loses $1 of its value. We have the 21 strike, so if it loses another full strike, we may look to buy that back cheaply and maybe roll down to the 20. What are some of the other things we wanted to do? Well, let's go into the alerts column here on our portfolio. And in the alerts column, we have a link for view. So this allows you to set the various alerts for the stock and for the option. And those of you who subscribe to Power Options can choose to have your alerts emailed to you whenever they're triggered. And the portfolio tool looks about every 5 seconds or so to see if any new alerts are triggered. We already talked about the stock price limit, our first leg on the position. I probably want to be notified if the stock reaches $20 per share. And you see here, once I start entering that, it gives me a choice to enter that as a red, yellow, or green. I'm going to put that as a red warning. So that's a warning to the negative. I'm not going to worry about the upside here for the covered call, but I may do the upside for something along the lines of a married put, diagonal call spread, for example, or a bull put or bear call spread. But for right now, I'm just going to put that in as well. And you could also put in a stock percent change if you wanted to be notified if the stock drops within 3% or 4% of your value. That's another thing you could do by percentage also. Now I can enter in alerts for the option price. If I want to be notified if the ask price of the option moves too far above the 120 or drops too far below, or if the stock, of course, drops by a certain percentage or increases by a certain percentage. For a covered call, I'm probably more concerned about the stock. I'm hoping it stays above 21. I get assigned and make the return. That's why I'm not putting in an upper limit. But for the lower limit, that's where I'm focused on. I'm focused more on the stock target right now than the option. However, if I'm in a bull put credit spread or a naked put, I may also be more focused on the premium if I need to look to buy it back to minimize the loss on the position. And days to expiration I'm not going to worry about. Now, you can also enter as a total position change. If my covered call return as a whole, the stock leg plus the option leg, decreases by more than 5% or 3% even, or if it increases by more than 5%, we might select that as well. What are some of the other important things in any strategy I might want to set as alert? Well, remember, in my search, I looked specifically for stocks that were trading above their 50-day moving average. At the same time, I was looking for stocks that did not have earnings between now and expiration and other events. So for this particular one, I'm going to look at that SMA, and I want to be notified if the stock drops below its 50-day moving average. If the trend changes, or even the 20-day, we could select. If the stock drops below its 20-day moving average, I may want to be notified if that happens. For longer-term positions, I may want to be notified on the days remaining until X dividend date if the stock pays a dividend 2 or 3 days. For a covered call, I feel this is important. So if it's a core holding in my account, I've sold a call and I'm looking to make a return, but I want to keep it. I want to maybe avoid assignment. If I'm right at the money and I've got the ex-dividend date coming up in a day or two, I may want to manage that position to avoid early assignment if I'm worried about the tax consequences. Okay, so those are just some of the settings there, and you can also use Bollinger Bands, days remaining until earnings. We already avoided earnings between now and expiration, so I'm not too worried about that at this point. But let's just check it anyway. Days remaining, 3 days away from earnings or so, and I'll just leave that as a neutral one at this time. Anyway, once I'm done with that, I'm going to go ahead and click Save Alerts. Now, whenever one of those alerts are triggered, we will see that our alert field will be highlighted in yellow or red or green, so we'll know which alert has been triggered, and we can view that. We'll also receive an email from it, from our subscription. Now, ease of tracking. We talked about before how you want to be able to track your positions easily. Well, here we're just looking at a basic view. As I enter more positions, the Power Options tools is going to link similar positions together. For example, if I had 5 covered calls, 3 credit spreads, and 2 debit spreads, I'd have my covered call listed, but they'd be linked together where the stock and the short call would always be on the same line next to each other. So it's not, just 5 stocks and then 5 calls against those stocks where I have to sort through what have I sold when and against what. And then I'd have 3 debit spreads, and they'd be separate. And then, 2 callers, for example, they'd be separate as well. Real quick, let's go to February 20th webinar. Is this the one I want to see? No, my apologies. Go to one of my other. Sorry, folks. Give me 1 second here. Oh, there we go. So this is what you'd see. We have 1 long call here. I have 3 married puts, but they're all linked together. 1 covered call, but I have more covered call. They'd all be separate based on strategy. So it's a much easier view. Now we go back to WETF, and we see here that we're seeing the stock leg and the option leg. Hey, that's great. We can see the individual prices for each one, the change in price today. The loss we have on the short call right now is just based on the bid-ask spread. But for an easier view, especially with multi-leg strategies, I'm going to change it from standard view here at the top to position analysis. And this still shows me my basic information. But now over on the right, what I can see is the position as a whole. So those of you trading credit spreads and debit spreads, covered calls, multi-leg strategies, collars, married puts. You want to select, I feel, this position analysis view from time to time because this shows me what was my original position cost for the entire strategy. Well, out of pocket, it was $19.78 per share, or $19.78 per share, or $1,978 for 100 shares. My original max expected gain, if the stock's above 21, is $122 or 6.2%. Now, my current liquidation value is $19.63, right? So we'd only get $20.98 back for the stock, but if we paid at the ask price at $135, we'd be at a small loss right now. Typically, every options position you open will be at a small loss once you open it, just due to the bid-ask spread, okay? And then the expiration value, we're not telling you where we think the stock's going to be trading at expiration, but this is showing us, hey, if the stock stays where it is right now, we might not make the full profit because we won't get assigned. We'll be at 6.1% of our 6.2% maximum gain. So there's my position as a whole to help me with easy analysis of where I stand on my position. But for those of you that are doing more advanced strategies, calendar spreads, for example, or even a calendar spread portfolio, credit spread portfolio, we also have the Greeks view. So this is a summary of your deltas on your position for your portfolio, the gamma, the theta, the vega, the current prices. So you can see a Greek summary of all the positions in your portfolio very quickly. If you're trying to do gamma neutral or delta neutral more likely, you can see that to help you gauge what you may need to adjust or roll or manage in order to keep closer to a delta neutral position or an even volatility. And lastly, even though we set the alerts for these, we can always check the important dates in the portfolio. When is our next earnings coming up? Looks like it's 65 days away. The ex-dividend date, well, the last one was on 5/11, so we know we won't see another one till 8/11 as well. But our stock WTF does pay a dividend as well. All right, so those are some of the views that you have available. Now, anytime that you're tracking the positions in the portfolio, we set our alerts, we've got it set. If you made a mistake when you entered your position, no problem. Using the Edit More Information buttons, just as we saw in the search tool, we can go into the Position Actions menu and choose to close the position, edit the position if we made a mistake at entry. If we want to add a dividend or convert it to a collar, we can select to add option leg as well. But what's most important, any strategy you're tracking in this position, is as the stock fluctuates in price, your position moves up and down, you can go to Position Actions and then Position Analysis. The position analysis gives you a breakdown of your current position. Of course, we know we just entered this today. Our next earnings and our next dividend date, we know we're past. We see that our current liquidation value, we saw that already, we'd lose about $23 or 1.2%. And a future expiration value, stock's falling on us a little bit, but if it stays at 2090 or so, or 2098, we'd have a return of 5.7%, a little bit less than what we expected. But as you scroll down below the position, you'll see potential rollout opportunities. And what we've done for you here is that we're showing you what would happen right now. It doesn't make sense to do it right now, I understand that. But in a given position, what would happen right now if we bought to close our current call and then sold to open a further out call at a different strike, higher or lower, as well. And what this tool is doing for you is showing you what would your new adjusted net credit be based on the original premium you received, the buyback, and the new premium that's available to calculate for you, do all the heavy lifting, what would your new percent of assigned be for this covered call and your new downside protection as well. And that's how it's going to help you with the management of your position. But let's take a look at a different portfolio very quickly. I'm going to go back to, was it this one I wanted to see? No, I'm sorry, folks. Okay, there we go. We have some married puts open, and I still have one covered call open, and that's what I want to look at. Not a bad covered call at all. The covered call position that we had for Intuit, let's take a look at that position analysis view. All right, so back a few weeks ago, or a week or so ago, we entered the position during a webinar, pay per trade, of course. We bought shares of Intuit at 102.35, and we speculated on the June 105 call, going slightly out of the money. We collected $1.50 for that premium. Our original expected return was 4.1%. We see that on the future expiration value. Okay, that was the max return that we'd get on the position. However, right now we could liquidate for a 2.2% yield. So we've made about 53% of our max return in just 9 days. This is giving me the bird's eye view of where my position stands right now and where it may be in 23 days. But if I wanted to try to maximize profit a little bit more, Only one of these really makes sense to me. But if I wanted to maximize profit, I could roll right now. I don't think I would, but I could roll right now, and it shows me that, well, we could go ahead and buy our 105 call back for $2. We originally corrected $1.50, so we'd be at a 50-cent debit, and we could roll out to the July 105 and collect another $2.65. So our adjusted net credit would be $2.15, and this would be a 4.8% return. This one I probably would not do right now. Even though the stock's slightly above 105, why go to July right now for the same strike, taking my increased return from 23 days to 51 days by only 0.7%. You see, in this case, I'd move from 4.1% max return in 23 days if the stock stays above 105 to getting just to 4.8% if I go out another 30 days from that. What's important here is this is only a 0.7% gain for a rough increase of 28 days. Now remember what we talked about before. In general, when I'm trading covered calls, I'm probably looking at a minimum return of 2 or 2.5% return. Well, that includes rolling. Okay, so if my goals are to make 2 to 2.5% per month, if I see a rollout opportunity that in the next 28 days only increases my return to 0.7%, that's not matching my trading goals. I'm not going to do that adjustment. We could roll now to the 110 call, but we'd only receive 85 cents, so our adjusted net credit would be 35. This negates our downside protection and puts me at a percent if assigned potential 7.8%. However, that would only occur if the stock goes up to 110. I am going to increase my return by 3.7%, so that matches my needs, but then I've lowered my expectation from about 50% probability of being assigned and making the 4% to only 23% of making 8% in the next 23 days. So I don't think either one of these are a good roll right now. But one of the other ways these tools greatly help you is that in addition to seeing things numerically, one of the most powerful features of our portfolio tool is I can see a rollout opportunity and I can select simulate trade from that more information menu, and this gives us a side-by-side comparison graphically of where our position stands right now compared to what our position would look like if we made this adjustment. And as we can see here, we saw the numbers on the other page. We could increase our return to 7.8% going out to the July 110 call. We see that we drastically increase our maximum return as well based on the chart, but if and only if the stock is above 110. So now I have to evaluate what are my expectations for this position going forward. Am I happy if I get assigned in 23 days and make 4%, or even if I get assigned early and make that 4% return? Absolutely. Otherwise, I wouldn't have opened the position to begin with. But the side-by-side comparison gives you a quick analysis, and based on your expectations of the stock moving forward, if you think the stock's going to be at 107 or 108, for example, I think it may be better to stay in your current covered call and wait till closer to expiration to get some of that time value out of the position, and maybe then roll intrinsically from the 108 up to the 110. Might not get as much of a return, but then again, you might, depending on what the decay and time value is on this remaining short call. And it's about $2 right now. It's right at the money. We saw a $2 buyback cost, so we're getting the time value in our factor. And you'll be able to look at this simulate trade, the side-by-side comparison, whether you're doing covered calls, naked puts, married puts, standard collar positions. You'll see rollout opportunities for long call buying, long put buying, or straddles maybe as well. Your credit spreads, debit spreads, iron condors, all those strategies that we support. You'll be able to do this analysis and evaluate which adjustment makes the most sense for your risk tolerance and your goals going forward as well. All right, so with all that being said, let's take a look here. How is PowerOptions your one-stop shop for options investing? Well, you can use that patented search tool in any strategy to quickly identify only the trades that match your trading plan. You can set your stock fundamental and technical criteria, and remember the key is don't be overwhelmed. Once you know the strategy you're looking at, set the 4 or 5 stock criteria that you think are important to you and the 4 or 5 option criteria that you think are important. Remember when we created our covered call screen from scratch, we essentially just looked at 4 or 5 option criteria for our time frame, minimum return, if assigned, liquidity, for example, and the minimum option bid price. And for our stock criteria, we just looked at stocks in an uptrend that were in our stock price trading range as well, and we looked for good average volume liquidity and avoiding earnings. Once you've done that, once you've identified the positions, we narrowed down the entire universe to only 13 covered calls that matched our criteria. And we avoided the first two by doing our further research and analysis. We looked at the chart, decided it was too volatile. In Altera, we saw the news. We decided this is a little bit too much going on. We moved on to the next position. We didn't like that chart, so we landed on our third position, which had the chart that we kind of liked, didn't have any news articles that would cause us hesitation to enter the position. Remember, we quickly compared it to the other strikes to see which one best suited our tolerance by going to the WETF 20 strike, still having an 8% downside protection or 3.5% return if assigned, or going up to the 22 strike if we were a little bit more aggressive and only having a 23% probability, but the chance to make maybe an 8% return if assigned. And then we use that profit and loss chart to evaluate our what-if scenarios. Once you've got the position settled, we enter it into the portfolio. Now we've got the ease of tracking your positions. You can see them as linked positions, so the legs are side by side. You have that multi-leg view in the position analysis to see exactly where you stand of liquidation compared to future expiration. You can view the Greeks and the important events in your portfolio. And then, as you're tracking the position, with one click, we can link to that position analysis view, see exactly where we stand, and we've done all the heavy lifting for you for your calculations if you make an adjustment or roll the position to a different strike price, turn a loser perhaps into a winner, or maybe get extra profits if you're looking to roll up as the stock has gone in your desired direction, or roll down if you're maybe in a bear call credit spread or another situation. Now, what can't we do? Hey, we're not a broker, so you're still going to need one of those. And for those of you that are maybe just starting out and looking for a broker, some of the most popular online options investing firms will be Thinkorswim, Interactive Brokers, Options House / Trade Monster. Trade Monster and Options House just merged together. Options Express, and then of course the old standbys. You've got TradeStation, E-Trade, Fidelity, Merrill, and so forth. You just want to do your own comparisons to which tools best suit your needs for an options broker and which commissions best suit your activity of trading as well. All right, so it's a one-stop shop for options investing, except for the brokerage account aspect. But what does it cost? We've got multiple levels of service for different levels of options investing. If you're just doing some trades here and there, maybe 1 or 2 trades a month, or I should say 1 or 2 trades a week, and you don't do many adjustments, or maybe you just do an average of 5 or 10 trades, you do most of your research, we do offer an end-of-day service. You'll have access to all the capabilities and the search tools for all the strategies we support, the research and analysis, and the portfolio tools, and that's only $40 per month. For those of you that are more active, you're doing a little bit more trading, or you know that you're making adjustments during the day, you may want to you'll be better off, of course, but with the delayed service. It's only $60 per month, and updates come out, date updates every 15 to 20 minutes. And then, of course, those of you that are trading during the day, a little bit more active, we do offer a real-time service as well. So every time you run a search, you refresh the page, you get the numbers and calculations at that very instant, and that's $100 per month only. And then, of course, you can add the historical suite of tools for backtesting purposes to the delayed or the real-time as well for an additional $40 per month on top of those subscriptions. But think about that for a minute. $60 per month, let's say, for the 20-minute delayed service. But if you subscribe to a service that gives you stock selection based on their list, VectorVest, Investors Business Daily, you're only paying $15 to $20 per month. Other services for options analysis, we talk about things might be considered our competitors, things such as iVolatility, or options, the different options trading softwares are out there. Those might be as high as $50 per month as well. And then, of course, you look at actually a lot of them are higher than us as to begin with. But then you may be subject to market news, Wall Street Journal, things of that nature, monthly subscription. You log on with your iPad now instead of getting a newspaper. That might be $15 to $20 per month. And if you have to contact your broker to help with assistance for adjusting an options position or evaluating a rollout opportunity, they might charge you a fee of $20 or $25 or more. So just looking at that alone, you're at $100 to $150 for multiple services when you can do all of that with PowerOptions, even with delayed data, for only $60 per month. So that's why we feel confident saying that PowerOptions is your one-stop shop for options investing. And compared to the other brokerages, Interactive Brokers, Trade Monster had some fantastic tools. Thinkorswim has fantastic tools. But we know for a fact, and we talk to customers who use both, that the search capability on PowerOptions, the amount of criteria that you can use and you can put in for the stock option selection and the stock selection criteria itself is much more fluid, much more various and much more useful than what is available on those other brokerage services as well. So that's why we feel that this is indeed your one-stop shop for options investing, and it's just a small price per month for what you would pay more for if you tried to combine that with other services that are available. All right, well, we've gone a little bit past our time here. It's about 1:15 Eastern Time. If you do have any questions related to the Power Options tools or what we discussed today, just use the question pod there to send me a question. We can stay online for a couple minutes longer. I'll be more than happy to answer any questions that come in. But remember, you can also email us at any time. So if you have a question at any time, send us an email to support@poweropt.com. And you can also call us during market hours. You can reach us here at the office at 302-992-7971. If you call the number, speaking of probabilities, you've probably got a 70 to 75% probability that you'll get me when you call in directly. Maybe a 30% probability you'll get Ernie, who created the Power Options tools as well. You'll definitely get your call handled. If we're not available, simply leave a message. We will call you back within 20 to 30 minutes. But indeed, you probably likely going to get me, or you're going to get Ernie. Or, of course, there's other staff members here that'll be able to help you out. But in most cases, you'll talk directly with me or directly with Ernie, so you know you're getting excellent customer service and excellent experience anytime you call in with any questions about options strategies, options trading, adjusting positions, or, of course, use of the tools on Power Options. All right, well, ladies and gentlemen, I didn't see any questions come in yet from our question pod, and we are a little bit past our time here, but I think we covered everything that we wanted to go through today. I'll encourage you, if you think of a question later, please send me an email or give us a call during market hours. We would love to hear from you. And I want to thank you all for joining me today, and I hope to see you at one of our next online presentations coming up in the near future. Take care, everyone. Have a fantastic trading week. We will see you soon. Good